Understanding minimum lease payments, a comprehensive guide. When it comes to leasing assets, one crucial aspect that both lessors and lessees need to understand is the concept of minimum lease payments. This term refers to the leased amount that a lessee is contractually obligated to pay during the lifetime of the lease. In the context of accounting, calculating these payments accurately is essential for both financial reporting and decision-making. What are minimum lease payments? Minimum lease payments are the expected payments that a lessee will make over the life of a lease agreement. Accountants consider these payments when recording leases in the company's financial statements. The concept of minimum lease payments is formalized in the Statement of Financial Accounting Standards No. 13, FAS 13, which outlines the accounting treatment for leases. Published by the Financial Accounting Standards Board, FASB, in 1980, this accounting standard provides guidance on how to classify and measure leases to ensure transparency in financial reporting. Key takeaways. Definition: minimum lease payments are the total anticipated payments over a leased asset or property, excluding certain costs. Present value calculations: these payments are discounted to account for the time value of money. 90% test: this test assesses whether a lease covers a significant portion of the asset's value, indicating how it should be recorded on the books. Calculating minimum lease payments, the formula. To calculate minimum lease payments, the following present value formula is used. PV equals sum underscore I equals 0, n a left, frac, PMT underscore open parenthesis 1 plus r close parenthesis to the power of I right, plus frac, res, open parenthesis 1 plus r close parenthesis to the power of n. Where PV equals present value of the minimum lease payments. PMT underscore I equals lease payment for period I R equals interest rate. N equals number of payment periods. Res equals residual value at lease end. This formula takes into account not only the periodic payments but also any residual value expected at the end of the lease term, factoring in the interest rate to reflect the time value of money. Importance of minimum lease payment calculation. The calculation of minimum lease payments is pivotal for various reasons. 1. Investment recovery assessment. The 90% test as part of the recovery of investment analysis determines whether to categorize a lease as an operating lease or a capital lease. This classification impacts how leases appear on financial statements. 2. Financial reporting. Accurate lease payments ensure compliance with accounting standards and provide stakeholders with a clear view of the company's financial commitments. 3. Financial planning. Companies can better plan cash flows by understanding minimum lease payment obligations, assisting in budget forecasts and mitigating financial risks. Recognizing rental payments. A full understanding of what constitutes minimum lease payments is vital. These payments include base rental payments, bargain purchase options, any guaranteed residual values. However, they exclude certain costs, such as executory costs, maintenance and insurance, that fall under the lessor's responsibility. Special considerations in minimum lease payments. It's essential to recognize that external factors can complicate the calculation of minimum lease payments. For instance, contractual clauses, basing estimates on average monthly payments, e.g., $1,000 for a 12-month lease amounting to $12,000, can be misleading due to hidden clauses or additional responsibilities. Guarantees. Lessee guarantees regarding residual values and payments related to lease renewals can affect the minimum payment calculations. Contingent rentals. Any rental payments that depend on certain conditions can impact the net lease obligations. Example scenario: calculating present value. To illustrate the concept of minimum lease payments, let's consider an example involving a leasing arrangement for heavy-duty trucks. Lease duration: 3 years. Monthly minimum lease payment, $3,000. Annual interest rate, 5%. Residual value, $45,000 after the lease term. Using the provided formula. PV equals frac 36,000, 1.05 caret 1, plus frac 36,000, 1.05 caret 2, plus frac 36,000, 1.05 caret 3, plus frac 45,000, 1.05 caret 3. Calculating each term results in Year 1, $34,285.71. Year 2, $32,653.06. Year 3, $31,098.83. Residual value, $38,873.53. Adding these together provides a present value of approximately $136,911.13 for the lease over 3 years. Conclusion. Understanding minimum lease payments is vital for both financial reporting and effective management of leased assets. By accurately calculating these payments, companies can ensure compliance with accounting standards, make better financial decisions, and accurately assess their financial commitments. Whether acting as a lessor or lessee, having a clear grasp of minimum lease payments can facilitate smoother operations and clearer financial insights.